дивиться.
Dear friends, thank you for coming, thank you for watching us on our website, and our current topic is EU experience in regulation of direct and venture investment funds and perspectives implemented in Ukraine. Our interlocutors are Armin Kammel, member of the European Fund and Asset Management Association. We have Dmytro Leonov, director of the Ukrainian Stock Market Development Institute. Dmytro Tarabakin, member of the National Securities and Stock Market Commission. Mr. Oleksandr Mertens, professor at the National University, the Kyiv-Mohyla Academy, and Vitaliy Shapran, expert of the Ukraine Society of National Analysts. And I would request you not to hurry up when speaking because we have simultaneous translation. So the floor is yours, Mr. Dmytro. Thank you for devoting your time and for attending the discussion. I think that you will have a possibility to ask questions to our guests from the European Union and to our colleagues. First of all, I would like to emphasize and to describe why that this topic is important and why it is important, why it requires discussion, why it requires attention from the society. You might know that we have chosen our European integration course, and because we need, in course of doing this, we need to adapt our legislation to the European legislation and to fulfill our commitments, particularly in the economic part. In order to implement DCFTA from January 1st next year. An important aspect of the DCFTA agreement is that we have to implement some parts of European legislation into regulations of financial markets, and more specifically, this is about the issue how to ensure sustainable involvement of investments and sustainable service of investors and development of the asset management market. I'm representing the Asset Management Association, which is represented by the funds which engage both direct and venture investments. And here we should clearly remember about the interrelation between risks and venture funds. Keeping in mind what I have told, we have a question with what? We have to harmonize our legislation. That's why we invited Mr. Armin Kammel, who is an expert in this issue, and we asked Mr. Kammel to comment how the activities of investment funds are regulated in the EU in line with different types of these investment funds. And it's my pleasure to give the floor to Mr. Armin Kammel, and after the presentation you will have an opportunity to ask questions. Thank you.
All right. Thank you very much for the very kind introduction. It's really an honor and a pleasure to be here, and I had been asked to give a little bit of an European overview of EU regulation and legislation in asset management. Can we have the slides, please? I've prepared a few slides for you, so that should make the understanding them also a little bit easier. I think I have 20 minutes, so what I want to do is to provide you with some of the challenges with the transposition of one of the crucial pillars of asset management regulation in the EU, which is the Alternative Investment Fund Manager Directive, AIFMD. Given the current environment in Ukraine, I do think it's probably one of the best fitting examples, but of course later on, if there may be some questions, we can also refer to other dossiers that we have in the EU. Next slide, please. So in the next couple of minutes, I want to focus, as I have said, after providing you with a general introduction of the concept and framework of EU regulation, which is also important for the understanding, with a specific focus on the AIFMD, and then I will make the one or the other additional remark on the Capital Requirements Directive and the Capital Requirements Regulation, which from a European point of view would be a classical banking regulation. And then finally, I will conclude with an outlook. Next slide, please. Next one. All right. When talking about European legislation, we have to keep in mind right from the beginning that EU legislation per se is very complex in nature. First of all, we have a two-tier structure, which means that on the one hand, we have like the supranational level. What we call supranational level is like the European level, and then we have the national dimension, which would be the dimension of the member states. What I've highlighted here are the players that are involved in the legislative process at both levels, on a technical level as well as a political level. And what we have witnessed, especially after the global financial crisis, is that topics as technical as asset management regulation became more and more political, which also has the detrimental effect that some substantial material technical discussions are kind of watered down. Next slide, please. More or less against the background of what I have said is that EU law has become a multifaceted, multi-layer toolbox, and basically EU law means for each member state that it is the overriding legal structure. In terms of the EU institutions, I think it's already known well that especially the European Commission is in the driver's seat when it comes to EU legislation, and that is then seconded by the Parliament and the Council. The reason why I stressed it here as a very general point is because at the end of the day, the legislation that we often have to implement is a compromise which results out of the discussions that we have between those institutions, and that compromise is typically found in what we would call trilogue negotiations. And in addition to that, it's probably also interesting from a regulator's perspective. We not only have national regulators, we also have European regulators, especially for the securities markets. It's the ESMA, European Securities and Markets Authority, which gained over the last couple of years substantial powers. So for example, the European legislator even has the power to intervene into products at national level. So if you just think of that from a conceptual point of view, that definitely also raises substantial issues in terms of the sovereignty of each member state. Next slide, please. All right, what I've brought here on that slide is also more or less a technical information, the very important distinction between regulations and directives. Typically, we had the tradition that asset management legislation was set up in directives. The directives did have the advantage that the member state had some leeway to incorporate the legislative stuff in the directive according to the national environment. However, we kind of realized in the European Union that when you have already 28 member states and each member state implements European law in a little bit of a different manner, you end up with a fragmented landscape, and therefore the tendency is that especially the implementing measures are now in the form of a regulation, and the regulation means that it's directly binding, so you have like a one-to-one implementation at national level, which should increase the harmonization of, for example, asset management legislation in Europe. Next slide, please. The following slide is about the Lamfalussy report. I don't want to go into the technicalities of that, but I want to stress what I have mentioned here with the four-level process. And that means that in order to implement European law, you have to run through various legislative levels. The first level is what we would call the framework level. So basically the European Commission, as the legislator, sets out the framework of the stuff that they want to regulate, which is typically a compromise solution, pretty often very vague. For the practical user, it's the problem that it's very abstract in terms of terminology. And this framework is then specified with level 2, the so-called implementing measures. And national member states typically transpose both level 1 and level 2 into their national law. However, Europe is not as simple as just having two levels. We also have a level 3, and that means like additional technical guidance by the European supervisory authorities, which reflects supervisory practices. And then we have even a level 4, and that means common enforcement tools at European level. Simply, when you kind of review the package, it means that from level 1 to level 4, as much as consistency should be applied when transposing European law into domestic law. Next slide, please. The De La Rosière report basically supported that, what I exactly mentioned before. The idea is to have stronger supervisory cooperation. We are all aware of topics like systemic risks, etc. So the De La Rosière report was actually stressing that there is a need for enhanced European cooperation. That's why effective crisis management procedures, etc. are on top of the agenda. Next slide, please. All right, let's move on now to the next one, and that will be the core of my presentation, focusing on the so-called Alternative Investment Fund Manager Directive. I want to start with some general aspects, and the general aspect is we have to understand what actually triggered the establishment of the Alternative Investment Fund Manager Directive. That was clearly the global financial crisis. It took the European Commission only 28 days after a famous G20 summit in London in April 2009 to come up with a draft directive which should regulate so-called alternative investment funds. Maybe two remarks to that. The first one is that the decision taken at G20 level was to regulate hedge funds. What the European Commission did, they simply said, well, we do not necessarily know how to define hedge funds, but we do have already an investment fund directive, which is the UCITS directive. So the simple shortcut is everything which is not the UCITS, which means the traditional investment fund regulation, is simply a so-called alternative investment fund. So from a conceptual point of view, that is already a problem, because in our industry terminology, an alternative investment fund is not necessarily a real estate fund, is not necessarily a plain vanilla, almost like UCITS fund, just with different investment limits. So the biggest challenge right from the beginning was already the draft that was proposed by the European Commission. And that's why I just wanted to underscore that with some figures. It needed 3 council presidencies, which means in concrete terms 1.5 years, and 1 very active rapporteur at the European Parliament, who was Jean-Paul Gauzès, who delivered more than 1,600 amendments to the original draft. So in order to be not diplomatically correct, tabling more than 1,600 amendments to a draft simply means almost rewriting the original draft. However, since there are certain political considerations between the European institutions, the whole thing went into the trilogues. And if we move on to the next slide, what we reached is a compromise. The compromise would actually fill at least 2 slides. I kind of cut it down to 3 important dates. The first one is in the year 2011, when the compromise on the AFMD was found at European level. And the compromise also includes certain time levers. The first important time lever that we have is X+4, so that means the year 2015, this year, where especially the discussion about granting access for third countries, third country AIF to the European market is discussed and reviewed. When we talk about third countries, we always talk about non-EU member states. So for example, from a classical European perspective, that would mean countries like Switzerland, Liechtenstein, the United States, etc. So what we have currently seen is that we are reviewing what we have agreed upon in 2011 under already changing regulatory and political circumstances, because I just wanted to remind you that in the meantime, after we have agreed on the original Level 1 directive, we changed already the Commission. So the previous commissioner was a Frenchman who was clearly in favor of regulation. Now the responsible commissioner at the European Commission is Lord Hill from the UK, and he is much more skeptical towards regulation. So just from a conceptual point of view, that's important to keep in mind. The other important date that I want to stress is X+7, that means the year 2018. And the year 2018 will be the year when the Alternative Investment Fund Manager Directive will be fully implemented. So if you just think of that from a legislative point of view, we have agreed on something in the year 2011 which will fully enter into force in 2018. Given the fact that there might be some substantial political changes in the meantime, some market changes, etc., that's almost like opening the box of Pandora. So when discussing about the Alternative Investment Fund Manager Directive and also kind of considering parts of it, then you definitely have to be aware that the whole thing is a very fragile compromise. Let's move on to the next slide, please. In terms of the material aspects, the De La Rosière report is again the starting point, which also contributed to discussion about the alternative investment funds, because De La Rosière linked the political discussion to something we are all best aware of, the so-called shadow banking discussion. And it was often kind of linked to say that alternative investment funds could be a potential source for systemic risks in the future. However, so far there was no proof for that argument. Fact is, and you find it also in the literature out there, that the Alternative Investment Fund Manager Directive from a European point of view is basically the example par excellence for ad hoc regulation as a regulatory response to a crisis. Let's move to the next slide, please. From a structural point of view, the European legislator basically went along a totally new path at European law, which means that unlike the traditional investment funds regulation that we have with the UCITS framework, the AIFMD is not a so-called product directive. This means in simple terms that when you just go through the legislative acts of the AIFMD, you will not find, or you will hardly find, any product features. You will not find anything about investment rules and the like. The only restriction that we have in terms of product features is there are certain limitations to the leverage. This means that from the conceptual design, the AIFMD is targeting at the manager. This is understandable because the distinction between the AIFMD and the UCITS framework simply is that everything that does not fall under the UCITS framework is an AIF. So in practical terms, that means real estate funds, open-ended or closed-ended, venture capital funds, private equity funds, UCITS-like collective investment schemes that do not fall under the UCITS investment limits, or hedge funds would all be covered by the Alternative Investment Fund Directive. So when you just compare a traditional plain vanilla real estate fund with a hedge fund, you see already that from a conceptual point of view there are huge differences in the product governance and the product design. So therefore, the European legislator didn't even aim to go along the line to kind of regulate the product features, but just to say the guy who is regulating whatever the AIF is, he should be in the regulatory scope, and therefore licensing processes are directly imposed on the alternative investment fund manager. Next slide, please. The principles and the scope of the AIFMD I've already kind of started with, so everything that is non-UCITS is considered an AIF, and therefore, basically as an additional caveat, it's important to keep in mind that the AIFMD does not make any differentiation in terms of the legal form. So you can have a contractual type of fund, you can have a corporate type of fund, you can have a trust construction, etc. Does not make any difference at all, would be under the AIFMD. The same goes if the structure is closed-ended or open-funded, no differentiation. The same goes if the vehicle or the structure is traded on a stock exchange or not. The AIFMD simply does not care. There's only one little caveat where we have a certain issue with the AIFMD, and that refers to the number of investors, because no matter if we are talking about UCITS or the AIFMD, we're always talking about collective investment schemes. So when you have the situation that you have an AIF with only one investor, you can kind of question if that is still a collective investment scheme. So the legal way out that it still remains an AIF is when the fund rules at least theoretically allow that in the future additional investors join. Another conceptual point which is important, the UCITS framework, which is focusing on the product, is from the design a retail directive. So that means the legislator, but then also the regulators, do want in particular to design the product to make it suitable for the retail investor. The Alternative Investment Fund Directive goes a totally different way and focuses on the institutional investor. That also means that we have two challenges. That before the AIFMD, there were already now AIF that were distributed to the retail public in the various member states. So therefore we have a retail option in the AIFMD. But on the other hand, the AIFMD also grants a passport, which means when a product is once licensed in the EU, you can distribute it to other member states. The caveat is when you're distributing an alternative investment funds to retail clients, let's say in Austria, you do not have the possibility to passport it into Germany because the rules for the distribution are different between, let's say, Austria and Germany. Next slide, please. What I've brought here is basically the main applications of the AIFMD. These are the three main cases. I mean, there are quite a few professors here on the podium. We could play some theoretical games and escalate the whole thing to 12 different applications. What I want to show with that slide is the AFMD applies as soon as you have a connection to the European market. So either you are a European alternative investment fund manager, or you have a European alternative investment fund, or the third option is when you are non-European manager distributing non-European funds, that you distribute this fund in the European Union. So the discussions that we had from a US point of view to impose laws with extraterritorial effects, the exact same story is done by the AFMD. That's why, for example, the Americans do not like the AFMD at all, because there are some prominent US managers who fall under this framework. The exemptions are very limited, like holding companies and typically those institutions that are connected with social insurance and pension systems. What is practically more important is that the AFMD offers some quantitative thresholds. So that means when you are very small alternative investment fund manager and you do not reach a certain threshold, then you do not have to apply for a full license. You only register with the regulator, which means that the regulator knows that you are out there, and the regulator gets basically on a quarterly basis certain information about the development of the company, about the development of the funds. That is important because what we have seen since the AFMD had been implemented, that especially the very small ones only registered and did not opt for the full licensing. Another little irony is that there were certain privileges for so-called UCITS management companies. However, all those who went through the licensing process didn't really see any privilege, because it was a fully fledged licensing process with lots of data to be submitted. So the privileges were very restricted. Next slide, please. When you just look from a legal point of view at the framework of the AFMD, I just want to give you a little bit of a flavor how complex it is. The Level 1 directive, as I said, is basically the framework, setting the scene. Then we have a variety of Level 2 measures, kind of specifying what is laid out at Level 1, and there you see already a bunch of regulations, delegated regulations and the like. Those are typically directly applicable no matter what the member state law says. In addition to that, since there's not enough clarity between Level 1 and Level 2, we get certain additional, especially technical guidance from ESMA, the European Securities and Market Authority. And I have just brought a few examples with me. And in this respect, I also want to stress a little irony. The second bullet point says guidelines on key concepts of the AFMD and types of AIF. ESMA published these guidelines when most of the European member states had already implemented the AFMD. So in concrete words, that was kind of written in these guidelines was practically simply not feasible, also kind of reflecting some of the challenges that we have at European level. Next slide, please. When focusing at the AFMD from potential and risk management regulation, we have a few concepts and a few aspects that are worth stressing, especially against the background of a lack of product specificities. So we clearly have certain requirements in terms of capital adequacy. We have fairly strong organizational requirements and also requirements for the risk management process. The important feature is, however, that both capital adequacy requirements as well as organizational and risk management principles are basically derived from the UCITS framework. So when you basically compare UCITS with AFMD, you see that the basic notion is the UCITS framework, but the emphasis on in terms of the AFMD is definitely more on risk management than compared to the UCITS. Next slide, please. Another not surprising feature of the AIFMD is a special focus on liquidity management, because you simply have in this kind of broad application of AIFs illiquid instruments and illiquid funds. For example, you can have potentially some highly illiquid real estate funds, etc. So therefore, from a prudential point of view, it's important to have certain liquidity management principles and practices in place. And then we have another feature which was basically copy-paste from banking law, and that is remuneration policies. So in Europe, we started out with a discussion on banker boni, kind of saying, you know, these Wall Street guys, the investment bankers, they simply earn too much. So that's why we have to introduce a certain cap on their remuneration. However, the problem is that both European policymakers as well as to a certain extent European regulators still do not understand the difference between investment banking and investment funds. So that's why, since hedge funds were also in scope of the AIFMD, there was pretty quickly a political consensus to introduce remuneration policies for AIFMs. They are, to be fair, more detailed, especially against the background of the practice of investment management compared to the CRD remuneration policies, which is also important because otherwise the consequence would be that banking remuneration rules would need to be applied to investment managers, asset managers, and that's typically not compatible. Another issue that is worth stressing here is that similar remuneration rules will be introduced now by March 2016 in the UCITS framework. So in this respect, we will have compatibility between UCITS and AIFMD. Next slide, please. We also do have certain restrictions on investments and investment strategies. That sounds probably more harsh than it practically is. The idea behind this, since the regulator is focusing on the manager, they simply do want to have an idea what strategies, what investment limits are applied by the respective manager. So therefore you need a kind of quasi pre-approval from the regulator in this respect. Another aspect which is worth noting is everything that relates to outsourcing and delegation. You do have, as an AIFM, the possibility to outsource and delegate certain activities. Most important is, and that is fairly harshly executed by European regulators, that the regulators are informed about the outsourcing of the respective activity to the relevant third party. Next slide, please. Another, from a practical point of view, very challenging aspect is the notion of regulatory reporting, which means there is a standardized data spreadsheet that alternative investment fund managers have to report to their respective regulator for both the manager as well as the fund. The idea behind this is that the data is forwarded to the national regulator aggregates it and then reports it to the European regulator, and then the European regulator ESMA forwards it to the European Systemic Risk Board. So there's this nice theoretical ideal situation that there's somebody sitting at the European Systemic Risk Board, and based on the various data that this person receives, the person can kind of detect some systemic risk. You hear already the irony of my remark, because at the end of the day, if you just think of data collection already in one member state, then you escalate it to 28 member states, and then there sits somebody somewhere in Frankfurt taking a decision if there's a systemic risk in a particular fund, in a particular niche, in a particular member state, who will really pull the trigger? So that's why it's more a theoretical concept which is costly and hasn't proved to be effective. In terms of investor and shareholder protection, we basically apply the principles of UCITS. To conclude, maybe just quickly the next slides. Just a few words on CRD, because I had been asked about that as well. I want to stress that the Capital Requirements Directive, which is the banking regulation in Europe, does not apply to investment funds. There's basically only one exception, and the exception is Austria, for the simple reason that management companies in Austria do have, for traditional reasons, a banking license. So therefore, since Austrian asset managers are holding a banking license, an asset management license, being like a UCITS license, plus an AFM license, so actually we end up with 3 licenses, we partly have to apply some principles of CRD. So now you can imagine that you have already 3 complex regulatory dossiers, and of course there are certain conflicts of norms. The principle is that always, that's common in legal theory as well, the specific norm applies. So since they are asset management companies, either UCITS or AFMD applies, which also means that CRD is only the backup solution. And that's why, for example, when you have a look into the Austrian Banking Act, Article 1 says, well, asset managers are by law banks, have this special license, but then already in Article 3 there are vast exemptions from banking law. And I think that's really crucial, because when you just look also at the regulatory environment, we have a European Banking Authority and we have a European Securities and Market Authority. It's absolutely clear in all member states that asset management falls under the securities regulation and not under the banking regulation. The only way where asset managers can at least indirectly fall under banking regulation is when they are part of a banking group, and therefore, according to the consolidation requirements, they would have to apply some of the banking law features. Next slide, and I think that's the last one. Next one, please. So maybe just a brief outlook. What we will see next year in Europe is what I would call the going live of the AFMD framework, simply due to the fact that there are certain member states out there, namely Poland and Romania, that have not even implemented the AFMD as of now. They gotta implement it with the UCITS 5 implementation, most likely in March 2016. We will also have quite some clarifications in terms of the passport, because ESMA so far only accepted that Guernsey and Jersey are the only jurisdiction that have a comparable supervisory framework, which is also a little bit of an irony, because countries like Switzerland, the US and the like are not deemed to be comparable. And the other huge issue that we will have to deal with next year and in the years to come is everything that relates to the so-called concept of the Capital Markets Union, where we will have specific discussions on venture capital funds, private equity funds, but from a legal point of view, and that's probably the positive side of CMU, is that we will hopefully also end up with clarifications of terms. Because currently, under the UCITS framework, the AFMD framework, the Prospectus Directive, the Transparency Directive, etc., we end up with different notions of very basic terms. For example, one of my students wanted to write a master thesis just on the different interpretations of the term security under European law. He started with a first draft proposal, and then he kind of realized that that would go beyond the scope of a master thesis. It's so complex that you would end up actually writing a PhD thesis just with the different notions of terminology. So against that background, we also hope that that will be clarified with the discussion of CMU. So I hope I provided a short, rough overview of the European dimension, and I'm looking forward to the discussion. Thank you.
Дякую, Арміне. Українська асоціація інвестиційного бізнесу.
Thank you, Armin. Ukrainian Association of Investment Market has carried out its analysis, and in a moment we will show you the comparative structures of different investments in Ukraine and in Europe. By numbers, by scope, by quantity, and when we are waiting for the presentation, I have a question to Mr. Armin. How do you think whether it's maybe too too much efforts imposed by the European authorities, which applied special directive, because in the past there was a directive regulating public funds, and why it was not possible to apply the same principles for regulation of investment funds. Maybe this was done to prevent some deteriorating financial influences in the market, or how do you think why this was done?
Numbers of usage were not basically transposed into the AFMD. Okay, well, the reason behind that is fairly simple. The first reason is there was a political momentum. The AFMD is the result of a political compromise to regulate hedge funds. That is absolutely clear. And the other aspect is that given the fact that the AFMD in scope is so broad, really ranging from UCITS-like funds to highly speculative hedge funds to super illiquid real estate funds, you simply could not impose or apply the same principles than for traditional investment fund regulations like with UCITS, and therefore the concept and the procedures that were put in place was like really to focus on the manager and basically leave aside everything that deals with the product, with the little exception of limiting the leverage.
Дякую. Покажіть, будь ласка, перший.
Can you show the first slide? As to the quantity of these institutions, number of institutions in the EU. So the quality is mainly equal of these institutions in Europe, both of them. So the situation in Ukraine is different. So public funds is about 89% are the funds that are classified by European legislation as alternative. As to the assets and that are served, the situation is mainly the same in EU. The main part of funds, about 60%, is in public funds and 36% in alternative. And in Ukraine, in public funds, 99.97% is the direct venture investments that are invested in the real sector. And this division is surprising. It's difficult to implement European regulations in our practice because we have a situation that we implement the requirements that are used in EU to public funds, but we spread it to other types of funds. So the requirements that have to be attributed to several percent of institutions are used for 100 institutions, and this is a matter of concern for us because even these institutions there was no investment, and there will be some perspectives. Maybe we could have time to study the experience and to practice in reality. But now these institutions work. And the cost of this decision is the sums that are billions of hryvnias and hundreds and thousands of dollars. So so the assets of share funds that belong to alternative, they are more than 200,000 million hryvnias, and they also provided billions of hryvnias for investment. So in this case, these financial institutions, they address association. Why do they have to address regulatory requirements that are not correspondent to European requirements and that can stop their work, because if they do not meet requirements, their activity will be stopped. So in this case, there's an issue that the variant of introduction of European legislation, if we started from the beginning, if we started from square one, and there was no such institutions that they were not integrated in the economic process. But there is an issue. Is it possible to combine and to regulate the situation, and that the adaptation of European legislation was complex, and from the other side, that we shouldn't disrupt economic processes that are provided by the institutions that use these regulations. And our speakers considered this issue, and I would like to give the floor to the representative of a regulator, Dmitry Tarabaikin. Thank you, Dmitry. What can I say? I do think that we have good approach to implementation, and we have a project for the next year of use it as we have it. We don't implement this directive, and as I understand what Mr. Leonov says, he says that we have tough requirements for the companies, and I think that we achieved this together with the association. We found a compromise when we allowed, as our colleagues said, the first part of the year was rather good, and we have prospects. We have 50% discount as to the norms, and we think that that was a balanced decision. And our general policy is that the era of irresponsibility is gone, and we hope that it won't return, and this is the message we want to send to everyone, and we want that everyone hear us. And as to the transition period, we are in the market, so we will try to find a compromise, and we want to be heard. Business without money ended. And in order to make business where people manage monies of the third parties, for this we should have expertise and all the necessary data, money, and our task as a regulator to create all the necessary conditions in order that business happen and for people to return, and the form of pension funds and other funds that the representatives of your association could sell to population. And we should understand that the norms and regulations should be observed, and the responsibility for violation will increase, and the rules of the game should be clear. The state should make everything possible in order that the participants of the market had the opportunity to earn, and at the same time the state should make everything possible to punish those who break the rules. That's why there should be capital, and the company should understand that it's forbidden to violate the rules, and there should be some sanctions for those persons who break the rules. Then we agreed with associations about that till starting from the second half of the next year, we will prepare threshold. It won't be called UCITS and alternative investment funds, but we will invent how to name it. Before we directly implement the directives, we will make this threshold among the companies that work with public funds and those companies that serve, as Mr. Leonov said, real business that is created to realize venture projects. We see that mainly the mechanism, the companies, business groups use the mechanism to make the activity more smooth. There are some tax opportunities, and that are realized, and it's not a question to us, it's a question to the Ministry of Finance. But our task, and we say to them that sometimes, of course, we think that those people who come and they want to build something, and if everyone of financial advisors that will go to a building business, so they should comply with the rules that exist in this kind of business. So we should respect each other. And as they say, if you are in Rome, do as Romans do. So we don't fly in the space, but we would like to say that there should be an order and there should be a responsibility, that's all. If people feel comfortable when they invest in projects using the infrastructure of this fund, so maybe it's a good idea. So thank you. It's very pleasant to hear that the regulator is ready, but in my opinion, we should start trading now. In order for the next half year, we would have a new compromise. The word compromise was present in the speech of Mr. Kammel, but we should make a compromise, and whether it's healthy or not, time will tell us. So we give the floor to Mr. Mertens.
Thank you for this opportunity. I think we have heard from Dmytro rather positive message that the Commission is able to understand the difference between retail funds and that is those funds which have access to retail investors, and alternative funds which are absolute different thing. That is what you had heard in Mr. Kammel's presentation. In Europe, there is a clear understanding that regulation of these two products should be different, and approaches to the regulation should be different. I would like to emphasize one more idea which was present in Mr. Kammel's presentation, and especially to our regulator to understand this, that regulation of alternative investment funds requires to regulate quite different products, and the main concern in Europe after a big financial crisis which was raised by hedge funds, which entailed huge market risks. For Ukraine, it's not the biggest concern. private equity and hedge investment funds. They require absolutely different regulation. You cannot apply the investment fund regulations to these funds. Some systems of investments could function even without asset management funds. So here we keep in mind that venture industry and venture funds require absolutely different ways to regulate, which should be different from asset management approaches. And about our sector. Next year, we will mark the 15th anniversary of the asset management sector in Ukraine, and we continue to say that Ukrainian asset management sector is very much different from the European one and from the United States, for example, and nevertheless, one of our problems, which we also heard in Mr. Kammel's presentation, that at the national level, regulation of the sector is, supervision of the sector is quite different, and regulatory basis is quite different, and in Ukraine it has also some specificities, and I should say we have many positive things here, and in our investment process remained in the light due to regulations. For example, this is good for construction sector. This is a good taxation structure which stimulates the development process. That is what I wish to say. Now I would like to give the floor to Mr. Vitaliy Shapran, Ukrainian Association of Financial Analysts. I will speak very briefly. In general, I would like to call a commission to shift to the risk-based regulations and risk-based resolutions, because what we saw in the Ministry of Justice, registered in the Ministry of Justice in November, we realized that this is a very obsolete document. For example, risk-free securities are municipal bonds, while in Ukraine these are risk assets and risky assets, and that's why we invite the Commission to follow some logic in implementing their reforms. First, improve mechanism of information disclosure, then strengthen the legislation about risk indicators, joint stock indices, various indicators, and those things which are used in banking sector today. So let us sit together with market actors and decide how we can apply European experience and the American experience to base our assessment on risks, our regulations on risk assessment. And I would like also to add that participation of the investment funds is shareholders of the big banks is prohibited by the National Bank. And currently we observe the persistent paradox that on the one hand, the National Bank requires that banks increase their capitals. On the other hand, it limits the instruments to attract this capital. That is besides those capital tools which are used to preserve control over companies, we should use other methods. That is, we have to demonstrate to the National Bank where our sectoral interest is. In the European practice, you won't find any big bank holding where without investment fund as a shareholder. So these two aspects which Ukrainian Association of Financial Analysts is ready to assist in our regulator, etc. And one small remark about one statement which you made about the time frame for our work. The association agreement, especially about DCFTA, which has not come to force yet, it provides for another 4 or 6 years to carry out this work. That is, we need not pass immediately the legislation. So looking at the timelines provided in the DCFTA, we clearly see that it fully stacks with the pace which was described in Mr. Kammel's presentation, the year 2016, the year 2018, etc. That is, before introducing something, you should review how it is implemented or how it is changed in the primary source. That is, introducing changes to our legislation, we should refer to the primarily European directive. Also, we need to have the national passport, how it was called. If we wish to promote national economy, we should understand that conditions, regulatory conditions and requirements to regulations should not, for national institutions, should be not worse as for international institutions. And at the same time, we should understand that in line with the association agreement, foreign institutions, foreign investment institutions will come to our market, which has softer regulations, while we, with very tight regulations in national market, we won't be able to allow the same conditions for national. If we have any questions, we are ready to answer, but within the time limit which we have. Well, dear colleagues, thank you very much. Let us shift to our Q&A session. Oleg Baichun, Ministry of Energy. After Friday 13th, those investors who were ready to finance our projects for 100%, they mentioned to us that we are ready, but if there is co-financing, if there is insurance of political risks. So my question is how Europe is ready to this, because we have rather good projects on the English public company is ready to cooperate with us because they are IPO indexes goes up when they conclude agreements about joint projects with us. You may add a couple of words answering to the question. We should speak either very briefly or within 2 hours. I think you are not the first to face similar problems when your co-investors say either insure your political risks or provide us with state guarantees, which it is rather difficult to get. One of the intentions of the round table is to show that we will be able to find domestic sources of investments in case the sector continues to develop. And this depends very much on the regulator, whether he is able to maintain the sector and not ruin it. That is, I agree with you that many are ready to invest, but the level of risks is huge. Thank you, Alexander. The next question. I have a question to Mr. Kammel. What protection is available for the fund participant, and what protection is provided for the public funds, which keeps its money in the bank which went bankrupt, whether there are any requirements in the legislation and requirements to the bank and to ensure the rights of the fund. Thank you. Тобто ви запитуєте про ІАФ або про використання ІАФ? Щодо UCITS, якщо ви інвестуєте в щось, то ви захищені як інвестор, тому що активи фондів, вони відокремлені від менеджера. Якщо навіть менеджер фонду, він постраждав, чи з ним щось трапилося, то сам фонд не банкрутує, якщо збанкрутів розпорядник фонду. Якщо там запроваджуються певні ліміти на інвестування, іноді ризики збалансовуються за рахунок того, що з точки зору регуляторної, що звичайні фонди повинні інвестувати тільки в ліквідні активи, інакше ви не отримуєте ліцензію. Тобто ви щось високоліквідне повинні. Тобто якщо щось трапиться, то ліквідність має бути досить високою. І це із інституційної точки зору необхідно для збереження платоспроможності. Якщо є управлінці активів і є депозитарії активів. 5-та поправка, яка буде введена в березні, вона передбачає, що якщо кошти зберігаються в депозитарі і щось трапляється з цими активами чи під делегованими активами, то депозитарій повинен замінити ці активи на такі ж активи або виплатити всі ці активи, вартість цих активів фонду. Тобто в цьому випадку також немає ризику для ліквідності. Thank you very much. Whether we have any other questions or any additional questions to specify something? Human.
Fully understand it. You were always talking about public funds. We in Europe do not know public funds in the clear sense, because what you have seen in my presentation is that as soon as a fund is offered to the public, then you simply make the distinction: is the target investor institutional or retail? And that makes already a huge difference. There's a certain caveat where we have so-called special funds, which are not offered to the public, but just to a limited scope of investors, where also the investment limits are totally different. So therefore, my impression, at least from the discussion that I was following, is that you are also really precise who is the target audience. Because just kind of saying that's a public fund, if you would talk to EU officials, and I'm in Brussels basically every week, they would have no clue what you're actually talking about. So therefore, I think the notion that we have at European level to say either institutionals or retail, that can be the way forward, because then you also have the mechanics and the tools to kind of fine-tune the regulatory aspects as well as the liquidity aspects at product level.
Ну, мабуть, я дам маленький коментар. Справа в тому,
I will also add one comment. When we had been preparing our information, we raised the question about the differentiation of different investment funds. Our legislation applies different approach and different classification of that funds. But the points of major concern, that is inadequate regulation or excessive regulation, they are about the funds which were described by Mr. Kammel. The limited number of investors, the limited offer of shares of the fund, it is a major concern. There should be also responsibility in equity, and the number of investors should be limited for them to understand where they wish to invest and to share the risks. And in line with this approach, we defined the risks in our market and showed you these two groups of investors on our slides. That is Mr. Kammel, and we coincide in our approach. We show to which funds different requirements should be applied as in terms of managers and in terms of depositories. Thank you very much. Whether there are any questions? One more question. My question is to Dmytro Leonov. Do you have any prospects for our market for the next 2 years based on the trends which we observe today and based on the regulator's position? As far as I understand, this is final question, and I would like to tell you the joke from the early 1990s. When just imagine one Warish who is sitting in the restaurant. He made a big order, he is drunk, and the waiter comes and says, "Will you pay today?" And this Novorish says, "Can you, what are you asking? Tomorrow is too far." So this is an answer probably to your question. Tomorrow is too far away. Seriously, everything depends on success in bargaining with the regulator. Whether we manage to establish proper timelines in building up our national institutions and requirements to this reform, and these requirements won't make any preferences to the international financial institutions who will come to our market, then this will allow sustainable national institutions to continue their work, while those which were established on short-term basis, they will disappear because they will find the new investment process meaningless for them. That is that should be the balance. The future will depend on the opportunity to work with clients and in access to money. If we do not create, if we manage to create good rules of the game, then in some years we will have good market here. Probably we will manage to preserve some resident companies, but we expect to have some shareholders of that national companies who are expats. But we have destroy our national investment funds in general. Thank you very much. With this optimistic conclusion, let's finish our discussion. Our agenda for tomorrow will be in 2 hours, and thank you very much for your attention. Thank you.